Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock in the stock market that recently announced earnings that could potentially be recession proof, as this video will show. And that stock is McDonald's. And we can see that over the last year, while the rest of the market is up around 3%, McDonald's is up pretty much like 20%. So they're completely dominating the market over the last 12 months. So in this video, I'm just going to look into some recent news that came out surrounding McDonald's along with their financial statements, and then lastly figure out the intrinsic value per share for this company so we can know if the current share price is a good price to buy into the stock at a value investing perspective. And so right here we can see from this article, it's titled, "Is McDonald's the ultimate recession stock to be holding right now?" Some key points they point out right off the bat: that McDonald's reported strong growth in their most recent quarterly results, even as it has been raising prices. And this stock was a solid buy during the Great Recession around 15 years ago, and it could prove resilient in another downturn. So right off the bat here, I highlighted a couple of key points I wanted to touch on in the article. They point out that the fast food giant's business hasn't been slowing down. The economy right now is obviously going through it. The United States real gross domestic product grew at an annual rate of around 1.1% for the first quarter, which is down from 2.6% in the previous period. And things are likely going to slow down even more in the US because interest rates are still rising and companies are continuing to scale back spending. But that being said, the demand for McDonald's food products remains strong even amid price increases. Same-store sales for McDonald's were up an impressive 12.6% in Q1. They point out in the first paragraph that whenever you're looking at restaurant stocks, looking at same-store sales is really important because restaurant companies tend to launch new restaurants, open new restaurants every single year. And so same-store sales are able to better indicate how business is doing for stores that were already open last year. And as we can see right here from McDonald's, not only were their same-store sales up impressively in the first quarter, but their growth rate actually increased year over year from 11.8% in 2022 to 12.6% for the first quarter of 2023. So that is very impressive for McDonald's. Also right here to end off this article, they point out that 15 years ago during the Great Recession, we can see that the S&P 500 lost around 36% of value. But if you include the return from the dividend payout for McDonald's, McDonald's stock was actually up 4 to 5% during this same time period. So while everybody else who was invested in the market during the Great Recession lost 36%, if you were only invested in McDonald's during that time period, you would have actually been up 4%. So this is just another example that proves that McDonald's could potentially be very resilient during economic downturns like the one we are currently in. And so right here, these are their financial statements. This is their balance sheet. We can see that from December 31st, 2022 to March 31st, 2023, total assets are up from 50 billion to 52 billion. And most of their business, actually pretty much all of their business, is financed by liabilities. They actually have more liabilities than assets on their balance sheet. And as a result, that ends up giving them a total shareholders deficit of around $5.7 billion on their balance sheet. And next on page 4, we can see their income statement. Total revenues increased from 5.6 billion to 5.8 billion, up around 4%, whereas net income increased a whopping 63% from 1.1 billion to 1.8 billion dollars year over year for the first quarter of 2023. So that is obviously some massive earnings growth, and that's definitely a good sign for anybody who is currently invested in McDonald's. And lastly, we can see their cash flow statement. Operating cash flow increased from $2.1 billion to $2.4 billion. And then we can see common stock dividends. They paid out around $1.1 billion to their shareholders through dividends, which is up from $1 billion last year. And then we can also see from treasury stock purchases, they purchased around $578 million, which is down from $1.5 billion year over year. So they are still prioritizing returning value back to shareholders, and they ended up paying out more in dividends for the first quarter of 2023 compared to the first quarter of 2022. So right here we can see this discounted cash flow model. Yahoo Finance is estimating that the company is going to grow at around 8.5% for the next 5 years. They had around $5 billion of free cash flow in 2022, and they have about a $46 billion net debt position on their balance sheet with 730 million shares outstanding. That puts their estimated intrinsic value per share at $46 per share, which compared to their current share price means that they are definitely, according to these Yahoo Finance estimates, way overvalued, considering the fact that they are trading at basically $300 per share at the moment, but their estimated intrinsic value per share is around $50 per share. So they're basically trading at around 6 times their current estimated intrinsic value. Then I compared them to some of the companies in their industry that they're competing with. Yum Brands, which owns companies like Taco Bell and KFC, and then also Chipotle. We can see that for gross profit margin and net profit margin, McDonald's is outperforming their competitors. They have the highest gross profit margin at 56%, highest net profit margin at 25%, around a baseline return on assets at around 11%, similar to Chipotle's. And they also have the lowest price to earnings ratio, PE ratio, at around 31 times earnings, and they're paying out the highest dividend per share at $5.66 per share. And that was actually one of the things the article pointed out makes this company's stock basically recession proof, and it's one of the reasons why their stock was able to perform so well during the Great Recession 15 years ago. And then lastly, I wanted to compare them to some of the other companies we've looked at in past videos. We saw that they are currently trading at 6 times their intrinsic value according to Yahoo Finance growth estimates. So that is not good enough to get them onto the board for the top 10 companies we've looked at that are trading at a share price compared to their intrinsic value. So far, Google, ConocoPhillips, GE, and ExxonMobil are the only companies we've looked at that are trading below intrinsic value per share. Their growth rate was estimated to be around 8.5%, which is not good enough to get them on the growth rate table here. And then in terms of gross profitability, they had a 56% gross profit margin and a 25% net profit margin. That puts them in 7th place on the gross profitability table and 3rd place on the net profitability table. Adobe still holds the #1 spot for the highest gross profit margin out of any of the companies we've looked at on this YouTube channel thus far at 89%. And Microsoft had the highest net profit margin at 36%. And then for the stock performance over the last 5 years, we could see that for McDonald's, they've returned a little under 80%, around 76% over the last 5 years, which is not good enough to get them onto the top 10 list for the companies we've looked at. Tesla still holds the #1 spot at 781% return over the last 5 years. But keep in mind, this return over the last 5 years is not taking into account their dividend payout. And if you were to include dividends, the return for shareholders over the last 5 years for McDonald's would likely be a lot higher than 76%. But without dividends included, they don't make it onto this chart. So with that said, compared to the other companies we've looked at, it looks like in terms of profit margins, they're doing really good in comparison to the other 20 to 30 companies we've looked at on this channel. But in terms of stock performance, growth rate, and share price to intrinsic value, they are not that competitive as we saw from this discounted cash flow model. And then compared to the other companies in their industry, the restaurant and food industry, they are doing really well from a profit margin standpoint, as well as from a PE ratio standpoint and a dividend payout. But in terms of return on assets, you probably have to give it to Yum Brands, like companies like KFC and Taco Bell. So based on that, I would love to know what you guys think about McDonald's in the comments section down below. Is it a good buy at the current share price? Let me know what you guys think. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.